here with us. Recording is now in progress. And you may have met him at last week's warm-up session for Seed Sprint. If you weren't able to make that session, we'll be sharing the recording this afternoon. But Anthony's got to hop to a meeting shortly, so we're going to pass it off to him now, and then Purdy and I will chat a bit more about Seed Sprint shortly.
All right, thank you. Good morning, everyone. Thank you so much for making it. So, as a serial founder myself, I started off the journey probably like most people in the room here, which is that it's all about the vision. It's you have an idea, you've gone for a run, you're in the shower, wherever you have an idea, and now you have to build things. And if you don't switch gears at some point, you spend your time fixated on building things rather than monetizing or spreading and getting out and selling what you've built. So these sessions are all about that mental gear shift from build it and they'll come to the team fixated on maximizing the output. Because although at SeedLegals, we're now about 100 people, we're the best way to do your funding round and get investment. Although we're here to help you get investment, raising investment is really almost the failure to not have to raise investment. So if you can get people to buy your product, that means you don't need to raise investment. And ultimately, your business should be something that becomes profitable. Now, that gear switch is at the point that you've built something and people are beginning to use it. How can you start measuring what's working? How can you start measuring what's not? How can you determine the right price point? So everything we're going to go for over the next few weeks is about your entire team culture and your way of thinking about building your business based on actionable outcomes to build sales, users, revenue, and so on. And you've got two goals in all of this. Goal number one, the big long-term goal, is to have people really using your product and generating revenue that turns you into a growing and profitable business. So you can have that world outcome, the change that you really want. You need to be profitable rather than burning money on that. But you've got a mission before that, which is to raise investment. And for that, you need to convince your investors that you have this mindset that their money is not going to be endlessly diluted as you just raise more and more, but rather that you use their money wisely in order to build the business to now start focusing on those metrics. So that's the overview. As a founder myself, who's done the journey a few times, it's probably taken me like the third or fourth time now with SeedLegals to have a business partner that keeps reminding me of these metrics. And just before I hand over, you might think that in your business, there are sort of three key roles for founders. One of them is the person who, the domain expert. That's the doctor, the dialysis machine, the mission you're on. I want to make this new bicycle, locks of bikes, never stolen, whatever. The other one is the person who's going to help deliver it. That's often the CTO or product person. And the third role is the Mr. or Ms. Business, the COO, the CFO, the person focused on metrics. And it may turn out that often the early stage founders, like myself, are probably less focused on metrics than on the mission. But that means you should ideally find yourself, if it's not you, partner with somebody who's going to be fixated on those metrics. And in the case of SeedLegals, that's really my business partner, Laurent. When we go to an investor meeting and the investor says, would you have any information on how your different cohorts behave? And Laurent will go, yes, if you turn to slide 55, we have a cohort analysis sliced 3 different ways. Which would you like? And at that point, investors go, he knows what he's talking about. I totally don't need to get involved in this. They definitely focus on metrics. So with that in mind, I will now hand back because I need to hop on our Monday 10 a.m. team stand-up to go through, in fact, the week's OKRs, metrics for this last week and the coming week with my team. So if anyone has any questions, if there's anything I can help on your funding round or metrics, drop me a note, anthony@seedlegals.com. Everyone have a fab time on the journey. And Richard, thank you so much for hosting today's session. Back to you, Purdy and MA.
Wonderful. Thank you, Anthony. Okay, so we have over 158 people here today. We have 260 startups signed up for Sprint, 300 including everybody's team members. If you have a co-founder or a team member who you'd like to have alongside you during the sprint, we have a special form for them to fill out. They need to complete a special form so we can get their email with and not, violate GDPR. So we have sent that form out in emails. We'll be putting it in the chat as well. So spread that around the team. And we'd love to have more people along for the journey. So we're going to be sharing more about what you can expect from SeedLegals after Richard's talk. But if you have a hard stop at 11, really quickly, Seed Sprint is all about helping early stage founders demonstrate to investors that they have the potential to grow and to be a profitable revenue generating business, even if you're pre-revenue now. The cohort right now is split between pre-seed and seed stage founders, which is why it's so fantastic to be part of a community where you have people who are a few months or a year ahead of you and people who are behind you as well. We're really hoping that, as a community, you knowledge share with each other, you share best practices, you share common failures. That's why we have the Friday sessions in the WhatsApp group. And then in today's Monday session is about getting the hard knowledge from active angel investors who have been there, done that, seen it all, and can give you a realistic, practical, and ambitious standard of what you should be focusing on over the next 4 weeks. I think that's about all that we'll share from Seed Sprint now, but now a little bit more about our fabulous guest today.
So today we're talking about product market fit. Sorry, before we introduce you, Richard.
Yeah, give a bit more context.
So what we're looking at in the first week really is engagement data. So we've spoken to a lot of angel investors and a lot of early stage investors, and the word metric normally is associated with like revenue, but at this early stage, they're really looking for this engagement data. So how can you prove that your customers or your users love your product, or how can you prove that they will love your product when you have a product? And that's what this week is all about. So how do you find out whether your users are going to love your product? You speak to them. So go out, find your users, find your customers, figure out how many you can actually go chat to this week and see what their feedback is. It's all about getting that real-time feedback this week. So where do you find these users? Where do you find the customers? How do you collect the data that you need? What kind of questions do you need to be asking them? What is really useful information that you can get from them in the next 5 days that you can then go back to investors and say, look, I've got all of these people. They're going to love using my product. They've told me that they're going to pay for it. This is the way that they're going to use it. This is why they want it. And that's demonstrating your product market fit. Back to you.
Perfect. So Richard is a very active angel investor who focuses on pre-seed, seed stage startups. He's been very active in the community and really does a lot to support startups. He's also been an early stage founder himself, so he's been on your side of the table and knows what practical and realistic growth looks like at your stage. He also helped launch Uber in the UK, so he has loads of experience, and we are so happy to have him for our very first session of Seed Sprint. Again, stick around afterwards, so we'll run through the details in like 5 minutes and we'll try to keep it snappy. But that's enough from us, so over to you, Richard.
Amazing. Thank you, guys. So I do have a slideshow, but I'm not able to share my screen. I wonder if you can
enable. Change that.
But it's okay. It's a very poorly designed slideshow that I put together myself. I am anything but a designer, but it's just a couple of slides. So let me try and share it if I can. Hold on. Can everybody? I think you should probably see. Or let me try and do, in fact, 1 second, sorry. Screen. There we go. Can everybody see?
Yeah,
perfect.
Can everybody see that? Okay, so like I said, it is poorly designed. But that is because I designed it myself and I am anything but a designer. But so first thing I wanted to do is kind of introduce myself and a little bit about why Purdy and Margaret Ann asked me to talk to you. So who am I? I currently work in the AWS startup business development team, but since 2012, I've been doing startup stuff. So I started out, as Emmy mentioned, I launched Uber in London back in 2012 before anybody kind of really knew what Uber was. Before that was banking stuff, it doesn't count, who cares? Then I went over to Rentify, which was a Series A startup. They just raised from Balderton, and I was their head of commercial. Then I did my own company, which was Shortcut, and Shortcut was unfortunately short-lived. We went through Techstars in 2014. We raised a seed round of just over £500,000, but we couldn't get the traction that we wanted because we couldn't get product market fit. And that is something that I'm going to be discussing with you guys today. Then went over to Teespring and then kind of onto AWS. And that's where I've been for nearly the last 5 years. In the last couple of years, I've also started to do some angel investing. And so I've got a list of some of the companies that I've got that I've invested in on that slide, and I've put in, because like you guys obviously don't know who I am. You've never heard of me probably before. You got an email from the Spice Startup guys that this was happening. So just, you know, who the kind of either co-investors or people who invested after me were. So, you know, Dishpatch literally just raised. So I invested in them November last year in their seed round. They just raised a Series A led by Andreessen Horowitz and Local Globe. Eola, I invested, they were my first ever investment, invested in them 3 years ago. It was a guy I worked with at Teespring. And I'm going to talk about them a little bit later. But then they recently went through the last cohort of Techstars and then raised a round from Pentech. Paid, I invested in them coming out of Techstars in their convertible note. And then they raised from Seedcamp and Crane. I'm not going to go through them all, but there's a few there. And I'm going to kind of, some of them will kind of lead into stories. And what I'm going to do is I'm going to go through this slide, but then I want to have kind of like an open Q&A, if that's okay. Purdy and Margaret Ann did the very scary thing of saying, do it however you want. Just present it. You can do a Q&A, you can do a slideshow, you can do whatever. So they left it all in my hands, and I was very scared, and I decided to do short slides and then kind of diving into Q&A. So that's me. That's my email address. That's me on Twitter. Always looking for more Twitter followers. Please follow me. Always looking for if you need any help on AWS stuff, feel free to email me. If you are ready for pitching, like properly ready, and you're looking for investment, you can also send me an email. But I don't want the inbox to become kind of bombarded. But yeah, I'm always happy to help with at least AWS stuff at the very least. So we're going to talk about product market fit, and there's so many different ways people think about it, or what is it, or whatever. And this just really means is being in a good market with a product that can satisfy that market. And it's really kind of difficult to define more than that. And you can feel it when it is happening, because things are being pulled out of you. More features and products are being put out of you by the customers. Money is coming in. You're going a little bit viral. And it's just, you can feel it when it's happening. And trust me, as a founder who was on the other side of that, we didn't have product market fit. Every sale was hard. Everything was a slog. You could really feel when it isn't happening. Your customers aren't getting value out of the product. Word of mouth isn't spreading. Usage isn't growing organically. And so you can really feel when it's not happening. And when it is happening, it feels a little bit like magic. So as I mentioned, I was in the UK. I launched the UK for Uber. And when we talk about product market fit, it doesn't need to have explosive growth. And there can be dips. And it doesn't need to start from a strong base. So for Uber was launched in 2012 in the UK. And, you know, the UK was a very competitive market. We obviously have black cabs. We had a lot of private hire vehicles. There was Addison Lee in London. And there was no guarantee that Uber was going to be super successful. And it started from a really small base. If I told you we were really happy if we got 7 trips in an hour. Like seven whole trips in an hour was like unbelievable music to our ears. But what happened was that grew a little bit by little bit by little bit by little bit. And then it kind of, if I'm honest, it kind of like stabilized. And it stayed where it was for quite a while. And we were all a little bit nervous. But what we hadn't put into the mix was proper marketing. And that's what we really did. But it was growing organically. There was word of mouth. People were using it. And what we found were that those people who had heard of Uber and were using it repeatedly. And that was how we could tell you, we've got something for this market which doesn't quite exist yet. When I did my own startup, Shortcut, unfortunately, we weren't getting that. And you could tell that it wasn't really happening. So why is market so important? Why is market so important? So everybody knows the product. Why is market? Because when you guys are going to raise money, you have to convince the investor that the market is large enough to support a humongous outcome for your startup, realistically. If you, as Anthony mentioned, if you want to become profitable, if you want to bootstrap, if you want to have what, is I think negatively kind of styled as like a lifestyle business, but is actually just like a normal kind of business, and you don't want to take outside investment, that's amazing. You're probably going to have an easier life, higher quality of life, and the chances of your company lasting long are probably higher. But if you are going after a humongous market and you need that outside investment, then you need to convince the investors that the market is so big that it can support a company of significant size, that their exit event is going to repay them multiple whatever they put in. And so that's why when you're talking about, and we're going to get onto metrics on the next slide, when you're talking about metrics, it always comes in, it always matters what market you're talking about, right? Because you could have, and we're going to get onto things like, monthly revenue run rate or annual revenue run rate, and it could be, maybe I say to you in this presentation, hey, if you guys hit $10,000 a month MRR, you guys are ready for your seed investment, or you're ready for your Series A, or whatever. But that's not necessarily true, because what really matters is the size of the market. If you've hit 10K MRR and the market's only ever going to support a company that gets to 15K because the market is generally small, then you're never going to get outside investment. It needs to be, we've got 10K now, and there's a chance of us getting 100K in the next year and a half, and there's a chance of us getting 1 million a year and a half after that, because the market is big and ideally the market is growing. Now, there are instances where your company, the company you're creating, will actually create a new market, but you still have to find ways of quantifying that. Again, back to Uber. If you look at Uber's seed, Series A, Series B decks, they always talked about the taxi market globally. Now, Uber created something new in kind of ride sharing and obviously Uber Eats, etc. But if you look at their initial decks, the money they were raising, they were always talking about the taxi market, how big that was globally. So you need to have a large market that is investable, that you are in and you're going, because all of your numbers, all of your metrics are going to be kind of in relation to that market. So it's important that you kind of keep that in mind. These quotes here are from a Mark Andreessen blog post about, the market basically always wins. Great team meets a lousy market, the market wins. A lousy team meets a great market, the market wins. A great team meets a great market, something special happens. And so that's what really investors are looking at. And so they will look at your TAM, as they call it, total addressable market. One thing I will say is, when you guys put together your deck and you're raising money, don't do the market is this big, and if we just get 1% of the market, we'll be this big, because investors can do the maths, and it's really, 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 really hard to get that 1%. So just something to keep in mind. So now we're going to talk about metrics, and there's a bunch of different ways to talk about metrics. And so what I did was I kind of split them up into the different stages you are at with your company. And this is particular for me, and every investor is going to have different things that they concentrate on at different life stages of the company. So for me, pre-product, right? Your pre-product, all we can know realistically is the team and the market. And so I'll give you an example from my own investing history. There was a company called Unitary that I invested in. They are a company that is basically doing content moderation for the internet. And so I look at that and I go, content moderation for, social networks and things like that. A pretty big market. It is something that is growing, going to be needed more and more. There are more social networks growing now. If you think about it, there was a bit of a plateau for a while, and now they're growing again with things like TikTok and Dispo and whatever else. Content moderation is going to be a big thing. So I looked at that and go, humongous market. The problem for them was the technical side. Is that if they can solve the technical problem, then the market is there and ready to be won. Market is big. What about the team? Team was unbelievable. It's the CEO is somebody called Sasha Haco, H-A-C-O. If anybody on this call has seen on Netflix recently a documentary on kind of black holes, and it follows like 4 people. One of them is Stephen Hawking, coming up with this new theory for black holes. So when I met Sasha, she was like, yeah, I work with Stephen Hawking, which A, in itself is amazing, but B, I was thinking, you know, probably like as a graduate student, one of 6 people in the room, and then, you know, rotates to the next year. No, she was one of the 4 people in this room on the documentary, literally coming up with this new solution for theories about black holes. Okay, so I've got a market that I think is amazing, and a team led by a CEO who's unbelievable. So for me, that's metrics. You don't have any metrics. And life is great because you can sell a story then. Then you get into the pre-revenue. Okay, so we've got a bit of a product, but we've not made any money yet. Okay, so what are you doing? Well, we're building a community around our product. Okay, that's really interesting. A team again, market again. And then if we're talking about a B2C company, you're talking about downloads. If you've got an app or monthly average users or daily average users, if you're talking about app or a website or something that is really B2C. Because B2C is a little bit different than anybody who's building a B2B business, in that monetization will likely come much, much, much later. So what we're looking for in those situations is downloads, monthly growth, daily growth, that kind of thing. So Dispatch is probably the only consumer company I've invested in, and one of the only ones I probably will invest in. They are, and by the way, I take no credit for anybody's business success. I want to put that out there. Teams have done them all themselves. I was just lucky enough to get in when I got in. They were the fastest growing company in the history of Entrepreneur First. Okay, Entrepreneur First is an incredible program. It's had incredible companies. They are the fastest growing company in the history of Entrepreneur First. They raised their Series A. It was 6 months after their seed round, led by maybe the best investors in the world, Andreessen Horowitz. So they're down, and it's not downloads, but it's kind of monthly average users, daily average users, and kind of the size of the ticket is pretty big for them. Whereas if you've got an app, a social network, anything like that, that's what you're looking for. And again, if you're pre-revenue, you're doing B2B, pipeline is pretty important. Show me your sales pipeline. How far along is everybody? Like, have you got any POCs? Agreed. What are you doing there? And then post-revenue, this is where it gets scary, because these are real numbers, okay? And you can't sell me on a fancy story. You can't sell me on a this is what we're going to do and this is how we're going to do it. This is real numbers. We've got growth. We've got revenue, and it's MRR, ARR, GMV, whichever way you want to split it or do. NPS. What are customers really thinking of you? Your growth rate and your churn. This is what matters to me. Okay, this is what matters to every investor once you actually have revenue. And like I said, this is the super scary thing, because this is when you have to show me real numbers. Everything else is a story and it's la-di-da and it's lovely and blah, 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 blah. This is nuts and bolts of your business, okay? And the things that really matter to me here personally as an investor is your monthly rate, but if you're super early, then you're not going to have humongous revenue if you're trying to raise some money, but I want to see that you're growing. And the other thing that I want to see is that the customers really love you, okay? And that your churn is low. So I'll give you an example. One of the companies that I am invested in, Eola. So what they do is they are the kind of business software for activity companies. And the massive problem that they had, their entire life cycle of the company, they could not convince an investor that their market was big enough. They had, and I mean serious struggles of convincing investors that the market was big enough. I'm lucky enough that I have a pretty decent network. I introduced them to a bunch of investors, and everything came back. Love you guys, love the product. The market's not big enough, and so they have struggled again and again and again over like a 3-year period to raise money because of that problem. But during that time, they kept adding customers. Their churn was basically 0, and the customers loved them. And so at a point, they continue to grow and they continue to grow and they continue to grow and they continue to please their customers to the point where they actually start to convince some of these investors, you know what, the market is big enough. And not only that, the market is growing. So like I said, it took them a couple of years. They went through Techstars. They've raised from Pentech, who I think are a really top fund. They've invested in a couple of my favorite companies. Might not be as well known as some of the other ones, but really, really top fund. And now they're kind of growing like a weed, and they're getting inbound from the top funds in the UK being, oh, I'd love to talk to you guys about your Series A. And that's the thing. If you just keep pleasing customers, keep talking to your customers, keep growing, eventually the investors will figure out that a market they know nothing about, they actually and I think is kind of big enough. Okay. So what I look at is your growth rate and your churn, your NPS as well. Now, so the other thing to keep in mind here is that if you are post-revenue, it's going to affect your valuation. I mean, all affects your valuation, but it's going to significantly affect your valuation, particularly in Europe, particularly in the UK. And there are, you can have an amazing team and that might increase the potential valuation. You might have previous exits, that's going to increase valuation, but ultimately if you're post revenue, it's going to kind of be like a multiple of X, Y, Z and whatever. So I'll give you an example. There was a company that I reached out to. They just come through Y Combinator. They had MRR of like 1.5K a month. Again, I don't care. It's good enough for me if their growth rate and their NPS is good enough. But their valuation they were looking at was 12 million pre-money. And I look at that and I say, 1.5K MRR cannot justify 12 million pre-money valuation, particularly in the UK, when you're going to struggle to hit that post-seed to, because you're going to have to raise your Series A and Series B from European or UK funds, and it's just going to be hard. So you have to keep in mind that your valuation has to be realistic, even if your growth rate is pretty high. So those are the metrics that I look at, and those are metrics any investor is going to look at. They're going to put different emphasis on different things. Everybody's different. They care about different things. So if you are, pre-revenue, even if you're kind of post-revenue a little bit, the only thing that matters is getting to product market fit, right? It doesn't matter, you don't need to build new bells and whistles. You don't need to have people in the, creating new features. You don't need to do, plow money into marketing. Trust me, I did that as a founder. If you don't have product market fit, it's just going down a funnel that you're never going to see the money back from, okay? So the thing that matters is getting product market fit. And the way you do that is you speak to customers and you iterate, and you speak to customers and you iterate, and you speak to customers and you iterate, and you speak to customers and you iterate. That is honestly the only way that you get to it. And you do like maybe a mini pivot, all that stuff until you really hit on this product that customers really want. You've found a pain point and people really want to use your product. And what I would say is that a lot of founders that I meet and a lot of founders that I speak to, particularly if they're non-technical CEOs who maybe have a CTO, they think that we need to have this finalized, finished product before anybody will use it. And so we delay launching and we delay speaking to customers and we delay getting feedback. I would advise massively against that, because you don't really know how customers are going to think about your product or use it until you get it in their hands. You don't really know what their pain point is. They might tell you what they think their pain point is, but the proof is really in the pudding and how they actually use products and what they actually pay for. So if you think, what is the pain point we're solving? What is the most kind of janky, basic way that we can fix that customer problem? Even if it's with spreadsheets and whatever, do it to figure out and show that you have actually found a problem that has value in it and that you can build a product for it. So this company that I know, their MVP was WhatsApp and Excel, right? Because they're using WhatsApp to speak to people on either side of the market, Excel to track everything, okay? You do not need to build this unbelievable, amazing software, beautiful design product to prove that there is a pain point that customers have and they're willing to give you money for, or that you were able to fix it, okay? So you speak to customers, you iterate, speak to customers, you iterate, speak to customers, you iterate. There's a few really important resources talking about product market fit. I think I'll be able to share this deck with you. I'll share it with Purdy and Margaret Ann anyway, and hopefully they can share it with you guys. Read all these blog posts, super important. It gives you really kind of good grounding and context. And that was it. Like I said, very short presentation, and we'll kind of dive into the Q&A. So I'm going to stop sharing. And I don't know, there are things in the chat. Let me see if there's a Q&A. Greetings, hello. All right, so here are your questions here. We'll make questions live. Put questions there. Okay. I'm going to answer the questions in the chat. So slides available after the webinar? Yes, they will be, because I will share them. What is a good week-over-week growth to get investors excited? To be honest, it depends on the product. It depends on the market. It depends on what you're building. I would love to see, and so I don't look necessarily week over week. I look maybe month over month. Anything over 30% is pretty good if you're at the early stage. And like I said, growth rate matters, but really what matters is the NPS and churn, because if you're adding 30 new customers every month, but you're losing 30 customers that were already there, that's a big problem. So you can't just look at growth rate. You have to look at everything kind of combined. What is your retention? Okay, what is the NPS? And then what is the growth rate on top of that? And I'm going to scroll a little bit. So what qualifies as post revenue? We have about 1K MRR from one enterprise contract, which we sold before MVP was even live, but not sure that's enough. 1 penny is post revenue. Post revenue is literally we've got revenue. Okay, because that's it. You've got 1K MRR. All right. So when the investor looks at that and they go, all right, well, how fast is that growing? And what is the, because like you have to tell them the story of actually it's only one customer. They go, all right, well, why have you only sold to one customer? What is happening that's stopping you selling the same solution, even if it's a storage solution, to other customers? What are they paying you for if you don't have the products built? All of those things. So literally, post revenue literally means we've got money. Somebody is paying us for something, and then you have to answer all those questions. Okay, it might be easier, and obviously I don't know. Sorry, Alex, I don't know what business you are. I don't know what you are particularly selling. Sometimes it's easier to kind of sign a contract for that money, but not accept it, and then you can tell investors, hey, we've got 3 contracts signed at, it's going to be 1K a month each, and we've got this in the pipeline. Because otherwise everyone goes, all right, so we've got 1K MRR, and you've had that for like the last 8 months, 9 months, what else is happening? So it really depends, because once you have money, it's harder to spin a nice story. All right, in terms of pre-revenue, what spreadsheets do you need to come prepared with? Now I'm different to other investors because, well, not different to other investors. I've been a founder, and so that I know all of these spreadsheets, like they're just bullshit and fairy tales. Okay, they're literally, oh look, we're going to get to X in profit by 5 years, and who cares? You're not, right? You're either going to absolutely blow it out of the water, or you're going to be dead. Those are the 2 realistic things happening. It's nice that you've done preparation. I don't look at that because it is nonsense. I don't think there's any startup in the world that has raised seed money based on spreadsheets and then has actually kept to those numbers, because it's impossible. You cannot foresee what the actual need for your product is going to be, and you're probably going to get your pricing wrong to begin with anyway, and you're probably going to be underpricing it. So it's like, what do you need to prepare? Do a couple of year projection, but nobody of any value is ever going to keep you to it. Okay, it's nice that you've done the homework and that you've looked at it and you can say, oh, if this happens and this happens and this happens, we're going to be profitable. But realistically, this is going to happen and that's going to happen and something else is going to happen. And then you're actually going to grow the team. And then, there's going to be a lockdown, and then there's going to be X, Y, and Z. And then there's going to be a competitor over there. So you need to reprice, and a million things are going to happen. It's good to have them prepared because, a cursory glance over them, yes, it looks like they've at least done some maths, but everybody knows that it's fairy tales and bullshit. I apologize for my language, but I'm Scottish, so it's allowed. As a pre-revenue, how would you put a valuation on your company? You have to kind of look at the market, right? So this is capitalism. It is what somebody is willing to pay for your company. And so you kind of look at, are there comparables? Are there companies that are doing something very similar or serving a similar customer base? And, what were they at? What was their valuation? And at the end of the day, the valuation is basically set by negotiation between you and your lead investor. And so you want to take as little dilution as possible. And they obviously want to have as much ownership as possible, because then if you're super successful, they return their fund with one investment. So it's a bit of a negotiation, but I would say be reasonable about where you are. I think in the UK, unless you have like a stellar, unbelievable, crazy team, pre-revenue startup valuation is probably going to be between £2 and £5 million. I think that's a reasonable start. There are some companies that blow that out of the water. There was an entrepreneur first company that, not the one I invested in, but they raised their seed round at like a £14 million pre-money valuation. And yeah, so it's just it's really it comes down to negotiation. But look at comparables and be realistic about the market that you're in, right? So when you look at, the YC company raised money at this and that YC company raised money at that, we're not YC companies. They get a YC premium, and I think the shine comes off that, particularly when talking to the UK market. But yeah, it's a negotiation. between 2 and 5 million is a realistic mark, I think, for a pre-revenue company. What about a two-way market, which only first had a market entrance several months ago? How can we extract real-term metrics from this? From Ewan, I don't know, to be honest with you. I don't know exactly what you mean, but maybe we can bring you into the chat and we can jump through the questions. I also don't know if this is the best way for me to answer questions. I don't, like, if we had a voting system, that would be cool to see what other people want to be answered.
What we can do, we're going through the questions, so we can just feed you the questions that are coming up the most. We've had a lot on valuation.
Okay, so look, valuation.
If that would be.
So like, sure, valuation is a really tough one, right? Like, realistically, it is a negotiation. It's what the market is willing to pay for a slice of your company. Okay, pure capitalism. Okay, if you have one investor and they're willing to invest in you at 2 million pre-seed or 2 million pre-revenue or whatever valuation, that's all you're going to get. That's because you have no leverage. But if you have 3 or 4 investors and, you know, one's at 2, one's at 2.5, you could probably bid it up a little bit. It is negotiation and leverage in the purest forms. It realistically has no basis in reality on your company. Sometimes it'll have a little bit of, you know, comparables. Oh, company X over there that serves a similar market raised at Y valuation. But if you're pre-revenue, even if you're like a little bit post-revenue, it's going to be negotiation. And so it comes down to you and your lead investor, and can you get other investors interested as well? Because even though we kind of put investors on this pedestal of, oh my God, these are the gods of venture, and they will come down from their mountain and they will deposit bags of cash in my bank account, they're just human beings, okay? They have the same emotions as other investors, which is FOMO. They are deathly terrified of missing out. And then they're deathly afraid of kind of losing money, right? So you have to understand, from an investor's point of view, fear and greed are what motivate them, same as for the rest of us. They are terrified of missing out, but they're also terrified of kind of losing money. And they have to report back to their LPs. So every fund obviously has LPs that invest in them. So that's like pension funds and private family offices. And so if the pension fund comes to them and goes, hey, why didn't you guys invest in Deliveroo? I know that you had their deck. And then you go to them, well, the valuation was a little bit high. And then Deliveroo IPOs at 3 billion and you pass them at 5 million or 10 million, then you look like an idiot, and then the pension fund isn't going to invest in you again. So the hotter a deal that you can become through no basis of reality with the business, sometimes, particularly if you're pre-revenue, the higher your valuation is going to be, because investors are human, they deal with human emotions, and it is a bit of a game, just like everything else in life. I wish there was a scientific answer that I could give you of, oh, you've got this much money, then you'll be this valuation. Unfortunately, it's not like that.
We've got another question up here. We might need more detail from the founders. So whoever asks us, if you want to raise your hand, we can try to bring you on for like 30 seconds if you want to go more in depth on your question. It was, we have gathered so much traction over the past 6 months from pre-product to post-revenue, but somehow investors always need to see more traction. How much more traction is more traction, as none of the investors exactly say? Okay.
So yeah, it would be good to have a discussion on this, because what they're saying to you is no. All right, more traction is no. Too early is no. Not for us is no. And what they're looking for is a free option on you guys, right? They're saying, oh, you seem interested, but there's no other investors that are interested to make me push my decision forward. So what they want, really, they want investment traction, right? So if you come to them and say, hey, Axel and Index are giving me a term sheet, they won't care about your additional traction anymore. They will be like, well, we were speaking earlier, we were speaking first, so let me talk to my investment partners and we'll see what we can get you on the table as well. By the way, what valuation is Index and Axel put on the table, right? More traction just means we're not interested yet, but they want a free option, which means they want you to keep telling them how you're doing constantly. And if anything really takes off, then they can be like, oh, I found this deal, this is one of mine, let's invest in you. But they think you'll probably grow at a similar steady rate. And until they are forced to act, they probably will not act. And they can be forced to act by your company going crazy in terms of growth, or another investor coming in and taking the deal away from them. And again, this is just human psychology. As shitty as it sounds, more traction just means no. And it means no until you really prove my inclination wrong. And that can either be by actually getting, going from 30% month over month to 120% month over month, or another investor's coming in and is taking the deal away from me. But in the meantime, please keep telling me how you're doing, because I would like to keep knowing. So yeah, it's just another way to say no. What I would do is, there are so many investors, and I don't know if you're raising from a fund or you're raising from angels or a mixture of the two. There are so many funds out there right now. There are so many angels. If you really are growing and you really are being successful, there will be somebody who wants to invest in you.
Fantastic. See, that's the sort of real feedback you get during these sessions. That's helpful. It's good to know when things are just a no, but people are padding the answer a little bit to, save themselves future down the line. Okay, next question. I like this question. Okay, product market fit. How long realistically should one work to find product market fit?
As long as it takes you. I mean, because if you have given yourself, and look, everybody's in different positions. So maybe you have, maybe you've got a family, maybe you've got children, so you can only have a certain amount of time to focus on this startup before you kind of have to go back to the real world and get like a corporate job. Don't do it, it sucks. But maybe you do, right? So you say, I'm going to give this 12 months or 18 months or whatever it happens to be. That's how long you need to focus on it, because it is the most important thing. It is the only thing. You can't be like, oh, I'm going to go and build more products features, because the customers don't want them. The customers don't want your product anyway. Who cares, right? I'm going to focus on marketing. When you've not got product market fit, you're just going to be throwing your money away on marketing. Okay, I'm going to do some hiring. Who cares? Because the customers don't want your product. You're going to be hiring people in a company that's going to die. Okay, so however long you have given yourself, you focus on product market fit until you find it, and then you can focus on the other stuff. And I take that from somebody who did the opposite. All right, so I had an idea for a company. It was shortcut. I sold a story. We went through Techstars. I sold a story. We raised money. We got some customers, but it was a slog, and it wasn't growing, and it was hard, and it was just an awful hard slog. And yeah, it would have been much easier if we hadn't taken on the responsibility of taking that money on, going through Techstars, and we just focused the first 9 months on finding product market fit and realizing actually nobody wants what we're selling. Maybe we pivot this bit, or maybe we do this, or maybe we do that, or maybe we do this, and then until we actually find something, then you go through Techstars, then you raise money, and you're off to the races. I think it is a lot of first founders' problem where they raise money before they really have product market fit, and that is the only thing that matters. So however long you have given yourself to work on your startup, that is how long you should focus on getting product market fit, even if it takes you the whole time, because that's the only thing that matters.
Okay, thank you. All right, next question. We're in the process of building our MVP. Huge market, very difficult to approach future clients until MVP is finished. One-to-one conversations are excellent. Do you agree? Or should we wait until our MVP is done? So I think it's about assessing like potential stickiness with clients as you're building out the MVP.
Yeah, so look, it's a tricky one. And again, it depends, right? Like if you are selling enterprise software, it's going to be much harder to have those conversations than it is if you're doing B2C, because you know a bunch of consumers. Every one of your friends and family members is a potential consumer for B2C product, or even B2B with SMBs, right? They're easier to get on the phone than some guy who thinks he's a high-flying executive at an enterprise. So it depends on really kind of what market you're selling to. But what I would say is have as many conversations as you can with people to make sure that you really hit on a pain point and you've really hit on a problem, and that your MVP will fix it. Because people are super open to talking about their job and their company if they don't think you're trying to sell them something. And so this is something that I employed, and I don't endorse being underhanded, but I was underhanded, and I used to basically create a fake Gmail account and say that I was a university student doing my master's and I was really interested in whatever industry I was selling to, and do you have half an hour to chat to me about your job and what you're doing? And I wasn't selling them anything, and I'd always get a positive response. And because what that would do for me would be I'd be able to go in and find out really what was interesting to them, what their pain points were. And I wasn't a leading conversation with, because if you come with a product in your mind or you're trying to sell something, it becomes a leading conversation. Would this help? What if we did this? And what if we had a product? No, just find out from 100 people that do the same job, what's their pain point? What is pain point for their team, and all those things. So I would have as many of those, like I said, in the slide deck, speak to customers, iterate, speak to customers, iterate, speak to customers, iterate, speak to customers, iterate. If you're building an MVP, that's great. Don't take too long, right? If you have hit on a real problem, even if you have something that is super janky and horribly designed, but actually solves a problem, people will still like it. They might not pay as much for it, and they might tell you all the things that are broken, and it might go down, not if it's on AWS, but it might go down if you're on any of the other cloud providers for a period of time, if you haven't built it properly. But if you're really solving a problem, people won't care about the other stuff yet, particularly your alpha customers and your beta testers, and let them know that they're part of this organization. You guys are my beta customers. You guys are my alpha customers. You guys, you've got my personal phone number. Anything goes wrong, you call me no matter what time of day or night it is. Okay. You guys are the people who are going to give me feedback all the time. You guys are my special customers. Okay. You're always going to have the cheapest deal. You're always going to have the newest set of releases because you're the one that we trust. So you don't want to go kind of general availability with a product that's super janky, but for those first customers who really need the product, I would get them whatever you can, because you can spend so long building an MVP and then it's embarrassing because customers don't use it the way you want to do it, and you spent a lot of time and a lot of engineering time heads down building something. Get it in the hands of customers as soon as you can, but be speaking to customers at the same time. Be upfront and honest with them. Hey, we want you to be an alpha tester. We want you to be one of our beta customers. We want you to be in this small group of 20 people who are going to get first chance at this. And then when you give us feedback, we're going to change things really quickly for you. Here's my phone number. Here's my email address. You can get me whenever I'm on holiday. You can get me when I'm sleeping. You can get me anytime, because what matters to me is how satisfied you are, because that is going to be the guy that is then your champion for 20 other people in the organization or other organizations.
Perfect segue to the next question. What's the range of NPS ratings from acceptable to phenomenal for an MVP stage company?
That's a good question.
We can post rev too, because I think a lot of people will find that helpful.
Yeah, so I don't have like to be honest, I don't have like a pure number on it, because there are different reasons that you can have a low NPS, right? So I think Oracle, for example, has a pretty low NPS because they lock people into contracts and the product doesn't do what it says it does, and it's super expensive and you need to do licensing, but people still use it. And it's not a company that I would want to build, but people still use it. They rake in revenue, but I bet if you ask their customers if they'd like to transform off of Oracle, most of them would say yes. Whereas when you're a startup, you're going to come in and you're probably going to have low pricing, most likely, realistically. You're going to have a product that breaks probably quite often. You're going to have bugs, particularly the MVP. You're going to have bugs, you're going to have things like that. But you're also going to have super understanding users, because they are, if you let them know that they are kind of the early testers, then your NPS should be pretty high because you built that trust. If you're in general availability, right? If you are anybody on the internet with an internet connection can try my product, you want an NPS of at least in the kind of top 80%, I would say, because that is anybody can try it. They can move on to any other product in a similar space of time as quickly as they found mine, and I need to retain them. So your NPS is pretty high when you're in general availability. Otherwise, I would worry about it slightly less, only in that you're going to have customers who really believe in you. They're your early buyers, your early customers, your early testers, and it's just, what matters more to me is churn, because churn is like, if your NPS is super high but you're churning loads, then there's something that doesn't correlate there, right? So what matters to me more really is your churn rate. Because that says to me, well, they might be telling you something in the survey, but in reality, what they're doing with their actions tells me something different. So NPS is important to keep customers happy. It's important that they like what you're giving them, but also at the same time, customers are really fickle, right? So it could be, oh, it broke for me this week and I don't like it, or the design has changed and I don't like it, or I could get hold of Richard and now I don't like it. But churn is sentiment into action, and that's what really matters for me. Again, like, I'm not every investor, so some investors will put like a really high bar on NPS, and some investors put a really high bar on product. Connect Ventures, for example, are very product focused, so I would not pitch Connect Ventures unless you have a really stellar product. But for me, I don't care as long as you are pleasing customers. But churn is the action of NPS, if that makes sense.
Well, that's another perfect segue to our next question, which is about churn. But firstly, I'll ask two more questions that have come up in the chat a lot. But after that, we want to give people the opportunity to ask questions live. So feel free to use the raise hand function, and then we will go through and calling you after we have 2 more questions from the chat. So first one, for industries where some churn is acceptable, like retail or consumer goods, would you be looking for a benchmark or industry average, or how can people talk about churn in a way that fits their sector?
Sure. So what you want to talk about sometimes is kind of cohort retention, right? So I'll give the example of Dispatch, right? So for those who don't know Dispatch, it's basically restaurant meal kits, all right? They partner with really top end restaurants, and they can send their meals anywhere throughout the UK. Now, so somebody might buy a meal kit 1 month, but they don't buy them the next month. So that is not necessarily churn, because you're not looking at MRR, you're not looking at ARR. The customer might come back in 2 months. So what you're looking at is cohort retention, right? So we signed this person up in January, and between January and we're now in July, I can't believe it, they have ordered 3 times. So we've retained this cohort. They're not every month, but we've retained this customer, okay? Now, you can look again and say, all right, so from January, we signed up 100 customers, and by July, 50% haven't ordered again. All right, so that's probably 50% churn in that cohort. So you can look at it as kind of cohort retention, depending on the kind of market that you're in. Or if you're looking at things which is kind of B2B SaaS, hey, you get a monthly bill from us and you pay it, or you log off. Well, then that churn is pretty easy to see, and it's pretty easy to tell you what it is. B2C, if you've got like a consumer app, a social network or whatever kind of app, then churn is monthly average users. Would I look at daily average users? Probably not. I would look at like kind of time in app and engagement with the app, but I probably look at monthly average users. If you look at the big social networks, that's what they report on. And so I would look at that kind of, what's your monthly average user? How is that growing? And of the people who signed up in month 1, how many are still using it 3 to 6 months later? I'll look at example for Clubhouse, right? I signed up, and this is only from personal experience. I signed up for Clubhouse very early on, and I used it a little bit, and I don't think I've opened it in the last 4 months. So I have probably churned. It's still on my phone, but I haven't opened it. So would they class me as churn? Maybe, depends how they look at their cohort analysis, but I would count myself as a churn user. But luckily for them, they're growing pretty well. So they don't necessarily care about Richard Howard, but it comes down to how you want to measure it and what is standard for your industry. And because everybody's, we've got 166 people on, everybody's doing different things. So it's hard to say which is right for your industry. If you're doing a SaaS product, it's MRR, it's ARR. If you're doing B2C, that's a social app, it's MAUs, DAUs, engagement with app. If it is enterprise, again, it's MRR, ARR, but you're probably also looking at size of the contract. Christoph Jans from, I can't remember what's this fund in Berlin? Oh my gosh. They specialize in SaaS companies. He's got a great blog post on kind of how to grow a $100 million business in SaaS and like which customers you should be going after and how to look at that. Also got a great blog post on kind of cohort analysis. Christoph Jans, what's the Point nine Capital. Incredibly valuable blog posts there if you want to look at churn and things like that. But again, every company you guys are building there is useful. So I don't want to be like too generic, but I kind of have to be unless I get specific questions.
Well, that was, you covered the last question, because the last question was going to be, how do you identify the different key metrics if you're B2B or SaaS? And I think you just powered through that. So perfect. We'll find that 0.9 article and put it in the weekly bulletin that we're going to be sending out on Fridays. And so now we're going to go to the audience for some Q&A. Okay, Charlie, you are up first. We're going to ask you to unmute yourself.
Hey guys, thank you. Richard, thanks very much for your presentation. It's super helpful. So I just wanted to ask, I've pivoted my company from being a dating events company operating and expanding pre-COVID to a central marketplace for the dating industry. So we've stayed within the same sector. Can I use my metrics from the previous company in this company to show sort of growth and lifetime value of customers and cost of acquisition?
Are they your current customers as well?
They are, yes.
And then, yeah, I mean, like, I think where it crosses the line is if you pivot and the customers you had previously are no longer your customers, but you're like, hey, look how cheaply I could acquire them before for the company that didn't really work and I pivoted away from. But if they're still your customers, and it's reasonable that the metrics are going to, at least, cost of acquisition and kind of things like that are going to remain the same, I think it's okay to use it. But I would be upfront and explain that when you're pitching that, I did them for this, but they've stayed with me through this, and I kind of, having spoken to them and having really understood their pain points, this is why I've moved on to this. But they're still my customers, we're still here, and I'm using them to acquire even more at a lower cost. Absolutely.
Cool, thank you.
Thanks, Charlie. Okay, Benedict, you are up next.
Hi, thank you so much for a really interesting talk. I had a question about business development, and you've mentioned a couple of times that you've had experience in that. What we've realized, we're a B2B fashion tech company, vertical SaaS platform, and what we realized is that initially we launched in January 2021. We got a lot of clients quite quickly, but now we're hitting this wall where we're converting the existing clients, but it's really hard to sign on new and find kind of new customers. Do you have any tips or any ways that you think I know this is a very general question, but if you give any tips about business development and how to kind of keep growing and keep on signing new customers, that would be great. Thank you.
Yeah, I mean, so my question would be, why are you finding it hard? Like, is the market, which we kind of spoke about at the beginning, not big enough that you don't have that many new customers that you can go out and get? Or, so like, what is the roadblock that is stopping you kind of acquiring these new customers?
I think it's literally just once we get in front of someone, they love it and they want to use it, but it's that getting in front of someone that's very hard. So our market is massive. It's the fashion. We can basically integrate with any fashion retailer that has an e-commerce store. So
how did you get the first customers that you got, the ones that are super excited about it?
It's inbound, like one posted on Instagram, then the other one saw it. There's like, I wanted to, and on and on and on. But now that we kind of exhausted that network,
sure,
it's kind of difficult to keep finding all these new leads. And if you have any,
so you need to do cold outreach, right? That's the first thing that I would do is cold outreach. So you said the market is massive. There must be 1,000 potential customers that you could reach out to. Find their email addresses. There's a bunch of companies that will share their data with you. You can get their email addresses. You can most likely guess email addresses of most people. It's usually first name at URL. That's how I did it. I'm pretty good at cold emails. And just like send email. Don't make it generic, because everybody can tell, right? Try and be as personal as you can. But hey, we're building this. We've got customer X, Y, and Z already signed on. I'd like to talk to see if it was good for you. So you can do one or two things, right? If you're a small company, and I'm a proponent of founder-led sales, so I would do it myself. Get that. If your market is as big as you say it is, there must be 1,000 potential customers. Get an email to them, get their email address, get an email to them. Cold outreach is the way that you kind of start. So I'm a proponent of the founder doing that. If you don't want to do that yourself, then you can always hire kind of like an outbound sales specialist. And just pay them on commission. Usually a junior person, it's cold emails, it's inbound, it's like and things like that. But that is how you build your first thing. And then if you really do have product market fit, it should be kind of going a little bit viral. If it's an industry is as big as fashion, but also as kind of almost incestuous, everybody knows everybody, well then word should be spreading, and people should also be referring you to other people that they know. But yeah, cold outbound is the way to go. And I cold calls, cold emails. I'm unusual in that I enjoy cold calling. Most people don't like it, but it's a lot easier, particularly in the UK, for people to ignore an email than it is for them to ignore a phone call, because it becomes super uncomfortable.
Fantastic, thank you. Okay, Andre, you are up.
Hey guys. My name is Andre from Superpower. We're a video therapy app for mental health, and we match people with therapists based on a shared cultural background and inclusively. So we've raised the pre-seed round on Crowdcube earlier on. We've built the product, then we've launched. We've been through an accelerator as well. We're looking for seed capital at the moment. We're running out of money quickly. We need probably to close around until the end of September, and we've been contacting about 150 investors, a mix of angels and VCs. We've done that quite early on. The question is it better to hold off for now until we get more traction? Because everybody that we've been in touch with, they say, yeah, but it's very competitive. We need a bit more traction. Then we've built something, and then we still need more traction, and so on. And one of our pre-seed investors is in the industry, and they said a couple of weeks ago that if a lead investor comes in with at least a considerable amount of the round, they'd be willing to participate and complete that round. So it's going really well. I think we have about 6 investors that we're progressing well with, but I'm not sure how to. We're in this position where we're running out of money. We don't have enough traction. It costs us a lot of money to get customers because we need to pay for ads, and that's where we are.
Yeah, I mean, this is a very, this is like a really tricky position to be in. So I've been there myself, and it's really tough. The only thing I can say is this, like as I mentioned earlier in the chat, more traction is a no, really. It's a no, but please keep me informed in case you actually do take off. So I would ignore those people for now and just focus on people who are interested, not purposely, but to hype up the other people who do this alongside Purdy and MA. But SeedLegals do a rolling close. So if you can get some people to commit now, do like a rolling close, right? Get 50K here and 25K there. At the same time, cut your burn to whatever you can, like cut it as close to the bone as you can, so that you can survive for as long as possible. And what I would ask is, do you think that you have what would classically called like product market fit? Have you got there? Are you happy that if you were to raise this new round of funding, you would really kind of take off? That you've got the kind of the basis for, rocket ship or whatever you want to call it?
Yeah, well, it's I'd be tempted to say yes, but I think we still have a lot to learn. Sure.
So look, you need money. Get onto SeedLegals, do a rolling close. Purdy and Amy, let Anthony know I'm doing a sales pitch for him right now, because you can get some money in. And this other investor who's like, oh, if you get a lead, I'll come in too. That is just an investor having like FOMO, right? Which is like, if you can convince somebody else, I'll come in because I'm scared of missing out, but I don't want to commit too much right now. You need to focus on people who are going to commit right now, because if you're going to run out of money in 2 months' time, you need money today. So get a rolling close going, start talking to angels who've invested in the mental health space, and get them signed up to do, can you do 15K, can you do 25K? And at the same time, cut your burn to as close to the bone as you possibly can. Figure out how you can onboard users without expensive ads. There must be, there's another way. That there was a so there was a company, and ultimately didn't end up making it, but they had a very interesting Dojo, I think was the name, and it was like a what to do on a night out kind of app, and they went through funding at the same time as us. They raised like a decent round, and they got so many users in that they stood outside train stations, the founders, and they handed a letter to the guy, to everybody who came through, and it was like, hey, my name is Richard, founder of Dojo app. We do this. We'd love you to try it out. And they didn't pay for expensive social ads, and not many people hand out like kind of personalized letters at train stations. And obviously there's not many people coming through the train stations right now, but what I would say is kind of use that as impetus for trying to figure ways to get more users without these expensive ads, because if that's a big cost for you guys, you need to cut that down to survive as long as you possibly can.
Yeah, thanks so much, guys. Yeah,
perfect.
I'm just going to open a window.
Yeah. While the window's opening, reminder, everybody does get £100 credit to SeedLegals. We'll talk more about that afterwards. So if you're going to do rolling,
and you also get credits for AWS.
Yeah. We'll talk about that.
We'll talk about that too. We're going to try to power through 2 more questions. When we call you up, please try to give your question in 20 seconds so we can get through 2. Okay, Leonie.
Hello. Hi, Richard. Thank you for this session. So my company, Palco, creates interactive video live shows for people who no longer watch TV, and we are in a B2B space. Given the nature of our product, we have created a customer upselling journey that starts with a very affordable product to help our customer to get to know us, and lands to our premium product that can be very expensive if they want. So we have our first customer that fitted perfectly this journey, started with a 25K per year product and ending now with a 240K contract with us plus monthly revenue share. So we are post revenue at the moment. When it comes to B2B, do you think growth per single customer can be a relevant metric, or do you think it only matters to have more customers and lower revenues per customer? I'm asking that because we are raising now, and despite our results that I think are pretty impressive, we are struggling in finding a lead investor.
Sure. So actually, it's a really good question, right? And it's something that, you know, at AWS we focus on as well, right? Which is, hey, customers using AWS, but you know, we think we can help grow their spend. And so we look at, you know, new customers coming in, obviously, but we also look at kind of the growth of spend of existing customers. And so it's a really interesting thing to look at. Now, the difference is that AWS has millions of customers. So we know that we can attract, and we don't expect every business, obviously, you know, not every business that is on this should be able to attract millions of customers, but the investors need to know that you can attract at least a few, right? Because otherwise you are solving a very niche problem for a very niche customer. And hey, maybe this guy's going to give you a lot of money, but maybe nobody else is. So I think once you can prove to me that actually, yes, this is a large market, again, remember back to market, right? This is a big market with a big problem, lots of potential customers, then absolutely, once you can prove that to me, growth within spend of a customer is really impressive and important, and kind of shows to the value of the product you're providing, and also the value of the relationship you're building. But if you've just got one customer, yes, it's great that you can grow their spend, but also, why don't you have the second customer? If this one customer is finding you so valuable, where's number 2 and number 3, number 4? And that's what I would worry about.
Okay, thank you.
Thanks, Richard. Okay, very last question. You and you're up.
Hi, can everyone hear me?
Yes.
Yep.
Okay. So I asked the question earlier, and basically we have a twofold problem. So we have a really good executive team, and we've got our ambassador internships in the pipelines now. We have several hundred bars on board, but our issues are we're the second entrant to market, and our main competitor plunged tens of thousands, if not hundreds of thousands of pounds into fake reviews. So before we get into the interview with investors, they check out our competition and say, well, you had hundreds of thousands of reviews which were fake because they were during lockdown. And so when we're trying to remain true to our ethics and our morals, we're really struggling to produce metrics on what we can do there without actually lying as well. So if you have any information on how I can remain true to our morals, and that would be amazing. Thank you.
Yeah, I mean, look, it is very difficult if you have a competitor, particularly if they're going to be a little bit underhanded like that. And they kind of, it sounds like they've taken, you know, kind of fake it till you make it to heart and probably a little bit too far. So what I'd say is, like, explain that to investors, prove to them that they actually are. And so what investors don't want to hear is you sounding like a bad loser, right? Oh, you're number 2 to market and you just sound like a bad loser. Oh no, wow, they cheated, right? That's never going to win in like the hard marketplace. So just prove to me that you can beat them, right? What you could do, which would be super interesting, if they've got a bunch of fake reviews, look at like when you type in their name, who are the first 5 or 10 bars that come up in the review? Go to those bars and bring them on as your customers. So you can say, hey, of their top reviews, there are customers now, right? And that's because they were fake. And if they've created these fake bars, like out of thin air or whatever, then there's not a lot you can do other than kind of proving to investors that it doesn't matter. But then just show how happy your customers are, show how fast you're growing. And you say, if these reviews were all right, they wouldn't be coming to us, they'd be going to our competitor. And you can kind of only concentrate on what you can concentrate on. So focus on the customer rather than the competitor. But if you want to do something kind of interesting, if these fake reviews have real places attached to them, go to those real places and get those as your customers. And you say, hey, they're top 20. Like, anytime you Google them or go to Trustpilot or whatever, those top 20 are ours now. So, you know, I don't know what their reviews are there for. You can also do something. You can, if they are tied to real places, reach out to those real places and say, hey, someone has put this on the internet on your behalf. You can apply to Google or Trustpilot or whatever to have them taken down because they're fake.
Richard, thank you so
Fantastic.
much. There's
Thank
going to
you.
be an endless amount of questions coming in for you, I'm sure, but at some point you have to stop talking and get on.
Absolutely.
Thank you so much for sharing so much insight. Thanks everyone for the fantastic questions as well. Hopefully everybody learned a lot from everybody else's questions and the responses from Richard. That's exactly why we're doing this together as one cohort. Remember that you can continue asking these kinds of questions in the WhatsApp group and on the chat, because we've got over 150 founders who all have their own experiences that they can bring to the table as well. So I'm sure there's a bunch of knowledge that everyone has that we encourage you to all share with each other. Richard, we're going to go through some more details about Seed Sprint. So if you need to jump off, that's absolutely.
Go for it. Guys, thank you so much for having me. Happy to answer questions. If you want to reach out to me on Twitter, if you have any more questions that I didn't get to, let me know. And I think the guys will be sharing the deck with you anyway. So hopefully it was useful to you, and good luck building.
Thank you so
Fantastic.
much.
Thanks, Richard.
Bye.
Okay, so yeah, if everyone can stay on for additional 5 minutes, we will power